Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
Joining us for a closer look at Apple is Maribel Lopez, principal analyst at Lopez Research. So we had some gains in the after hours, so perhaps we can start from that. The stock was up around 6% in late trading, albeit I'd imagine with fairly light volumes and such. And we have maybe three things to talk about: the performance, the stock buyback, and the dividend. How do you think that sits with investors, and what was most important?
I think everyone was surprised by the performance of the quarter. It was guided as a potentially weak quarter, so we were all expecting that. We had many research reports that were coming out of China that said that Apple was losing tremendous share in that market. They frankly came into the call and said that they had done very well in mainland China. So I think that was a big surprise for everyone and a big win for Apple. In some ways, they didn't quite pull a rabbit out of the hat, which is always what one expects from Apple. But they did a very solid job of navigating the quarter. It was still a mixed bag, though.
Yeah, Greater China revenue was better than expected. I think we can agree on that. It's still about $1.5 billion below where we were a year ago. So year over year, I think
Absolutely.
That's negative 8.1%. Have we kind of seen an inflection point here where Apple and China are concerned?
I don't believe so. I think we are still in a very tenuous position for Apple in the China market. It's going to take us at least a couple of quarters to figure that out, to see if there's any leveling out of that. Huawei had a very strong quarter, so that certainly gives pause. It's an extremely competitive market, and many of us are waiting to see what happens in the coming weeks with the software announcements that are expected at WWDC, the big Apple show.
Some might have had an inkling that the performance would not be so bad, in that if you looked at Qualcomm's earnings and also Samsung the other day, sort of spoke about, obviously returning to profit on semiconductors was the biggest thing for Samsung, but they also sort of indicated that smartphone sales were reasonably solid. So I'm wondering whether or not, investors here are waiting on the next big thing, or if they're just waiting for us to see gradual recovery in the smartphone market.
I think the smartphone market didn't have the same hit that the PC market did, but it certainly had everyone at some point in time experiencing some softness. And really a lot of that is timed to their releases when they have their big flagship releases, and if they're a little earlier or a little later. So I do expect, and even Apple, when they gave their guidance, expected they'd be up. They did not give guidance specifically on iPhone, but if they're expecting growth, iPhones are such a huge portion of the Apple revenue that we have to imagine that they're at least expecting some leveling, and they gave some good guidance in the emerging markets. The emerging markets have always been a bit of a wild card. It's the growth market for everybody in the smartphone business, and the issue is really, in emerging markets, will people buy premium flagship phones, which is the market that Apple really tries to address.
The other thing that was better than forecast was the revenue for Apple services, I think about $600 million above what the street was looking for. Is it a problem for this company when we begin, as one analyst put it, to focus on the services side and maybe put the hardware in the back or in the rear view a little bit?
I actually don't think so. I think that is the nature of a diversified portfolio. Even if you look at NVIDIA at their last GTC conference, obviously a strong GPU hardware-focused company spent a tremendous amount of time talking about building a software stack and creating a software revenue stream. So I think that is a good portion of where Apple expects to see its long-range growth. That doesn't mean that the smartphone market will fade. It also indicates, we're talking about services, but really a lot of what's happening in smartphones now is not hardware-based. Everybody has their chips. Everybody has a solid smartphone portfolio, with the exception there may be some that are foldable, some that aren't. So a lot of the areas they're differentiating in right now happen to be around the AI software that runs on the device. So Apple already has AI capable chips in their device. Now the question is, and that's what everybody's waiting for in the next coming weeks, are they going to make a big play that says that they're using a lot of AI to do things like help people take better photos with their camera?
Right. You've got the WWDC, the Worldwide Developers Conference, coming up from Apple. And I suppose they couldn't really say too much in this earnings report about what might be coming. Do you expect something kind of shocking and strong, or just only incremental in advancement?
I expect Apple to come in with on par features that are AI driven at WWDC, which is one of the things that they've been giving a lot of flack on. And frankly, if they come in with on par or slightly better, they'll actually do very well. They have a strong, loyal base. The iOS base actually doesn't move that much, really. So this is one of the things that if they can just keep pace with innovation, they could do very well in the market.
It's kind of interesting. Microsoft, kind of works with OpenAI. Then you've got Amazon and Alphabet together working with Anthropic. Has Apple kind of missed an opportunity here now, very quickly, Maribel, not to have partnered with an AI firm outside of the company?
It's still extremely early days. There are many large language models or foundation models being built every day. There's still billions that need to be invested in those guys to keep them going. So I still think Apple has a play yet there to announce.
Maribel, thanks so much for joining us. Maribel Lopez, principal analyst at Lopez Research. Well, the yen touched a 3-week high against the greenback in overnight trading. The currency really lifting its gains against the greenback. The currency likely facing some official support. And to discuss this, we're joined by Michael Wilson, Bloomberg FX rates market reporter and strategist, to join us here on the program. So we've moved from about 160 this past weekend to 153, and this range now, 152, 153, could be a key level, I suppose, because it was seen as resistance before. So how do we see it moving here in the short term, and how much do we know about whether or not there has actually been intervention?
Hi, mate. Thanks for having me. Well, first things first, I think that the move today, we actually made a new low down there, 152.88, not far from there right now. And I think the market has probably given up the ghost on the week in terms of taking it higher, just as a buy the dip mentality. I think that the price action itself, with or without confirmation of intervention, is enough to scare away dollar bulls for the moment, even heading into a non-farm payroll number tonight. But you're quite right that a little bit further down, that 152 level, which was previous resistance, that was also around about the level back on April the 10th when the US hot CPI print landed. And that's when it all really started, I suppose. And I know it's been building up for a while, but that was the catalyst, as it were, to really get those dollar bulls going and push up above that 160. On Thursday we saw a nasty move again after Powell spoke in his press conference, and again the short price favourite is intervention. Looking at the current account balances, I think the contention is that they sold about another $23 billion worth of yen in that moment. We won't find out till the end of the month, but if it walks like a duck and quacks like a duck, well, it probably is. So, what's been quite surprising just of late is that most of the commentary that you read, we get everything, as you know, from all the banks around the world. They've just they're casually just expressing that it was intervention. They're not hiding behind possible maybes or rumoured or any sort of qualifying phrase. They're just calling it out as intervention, which is actually surprising because we're very careful about those things ourselves. When most of the banks are too, but they resign to the fact that that's probably the only thing that could have done or could have caused what happened.
Yeah, it's kind of an interesting week, Mike, because there's been this spurt of volatility that began during the holiday on Monday in the Japanese session in terms of dollar yen. Is volatility something that we've got to be dealing with a lot more now than let's say we've had in the recent past?
Well, it's the overnight volatility was bid all week around about 24, 25 vol. It got up just to under 30 vol, which is a lot for dolly, and does have this seasonal spike that happens for, say, a non-farm payroll or Bank of Japan meeting. But only this week, only like this morning, post New York has the overnight volatility come off, which is actually unusual in itself, in that we're just ahead of a non-farm payroll print. But I do think the market's probably unless it's a really wild result there, I think the market's resigned to the fact that they're not initiating any new risk. They just want to get the weekend started because normally that volatility would be north of 20, but I think it's down around 14 now. So it's down 5 ticks since New York close. And that probably speaks to the event that the market's probably surrendering a little bit to the Bank of Japan or whoever is out there.
Well, it's a holiday in Japan today, too. That may account for some of the pullback, right?
It is. It is. And it is start of Golden Week, which is like 4 or 5 holidays in a row. And I think that's one of the drivers of the Bank of Japan, that they wanted to get this thing down and sorted before the markets got very thin for the next few days.
Yeah, because Monday's a holiday, too, in Japan. So, yeah, it really does look like... it's hard to figure here. I still think the dollar is really driving this, right? Because you had a big drop in the dollar, and a lot of that was tied to a kind of dovish Fed meeting and comments from Jerome Powell. And at least at the moment, as long as the dollar is weakening, why get out there and and try to bet on weakness in the end?
I think you're right. I think that if they were in on the Thursday after Powell, that was very opportunistic on their part. They timed it well and they got a lot of bang for their buck. But if we get a good fundamental from, let's say, a soft print tonight, it's best to let the fundamentals work their way through the market. We might wake up and see dollar yen nearer to 150, by about Tuesday when, Japan returns, treasuries reopen in Asia. There's no treasury market right now, or no cash treasuries. So I think that, we've got ourselves a good catalyst to trade off tonight. And, hopefully that suits the BOJ, and they, just stand aside and let the market, lick its wounds for now.
Give me your take on the Korean won, because I see it strengthening quite a bit. I mean, obviously, intervention is not the story in South Korea, although they've been dealing with kind of the same effect on their currency that Japan has. And again, it's the result of just this amazing dollar strength. What do you think is happening with the Korean won right now, as strong as it is?
I think it's I wouldn't say it's a collective effort or coordinated by any measure, but there is certainly that they're just every bit as vigilant, as I suppose, as Bank of Japan. And I think that maybe the Bank of Korea is probably leveraging off that and using the sentiment, as it were, where there's like this newfound respect for central banks to maybe not take them on. But there is that buy the dip mentality in dollar Korean as much as there is in dollar yen. So I'm not as close to say the Korean economy as I am the Japanese, but if the Korean economy does turn around, and in any time, say in the next quarter, you might see that high of 1400. It might be the equivalent of the 160 for dollar yen, and we might not be there for a few days or a few weeks.
Thank you, Michael. Michael Wilson joining us, Bloomberg FX and Rates Markets reporter and strategist. Terri Spath, founder and chief investment officer of Zuma Wealth. Terri, great to have you on the program. It seems like earnings and a patient Fed are enough, at least at the moment, to keep the plate spinning here in markets. Not everyone agrees, of course, but the market has shrugged off this mini correction that we've had, and it's hard to argue with the markets, I suppose. How would you characterize, your arguments on the path forward?
Yeah, thanks for having me on. Lots to unpack with that question. We are constructive on the U.S. stock market, kind of as a broad statement. We're, I would say, definitely more constructive on large cap stocks versus small caps. It's just been, a large and in charge kind of market. And a lot of that, as you pointed out, has been driven by earnings. We've had some very strong earnings reports so far in Q1, particularly in the tech sector, as well as some of the other sectors out there. I do think that you need the Federal Reserve to be accommodative. I don't think earnings are quite enough to overcome, some of these fears that have been floating around about potential Fed rate hikes. We don't think that's going to happen. We're quite positive it's not, but that doesn't mean that it's not a risk out there and it's not a concern. But overall, I mean, I think we're seeing really strong earnings. We're going to continue to see strong earnings. We're seeing a breadth widening in large cap side of the U.S. stock market. And so, we'll have to keep watching the Fed as we have been for a long time now as investors.
Yeah, yesterday, Chair Powell seemed to take the notion of a rate hike off the table, which is not the same thing as saying that we may not get a rate cut this year. Would that bother you if the Fed doesn't adopt a policy easing stance before the end of the year?
Well, yeah, it would. I mean, I do think it's time to take a little off and to trim a little bit from these, 2-decade highs that we've seen and very quickly in interest rates. On an absolute level, the interest rate level is still fine, but it went up so sharply at such a level that hasn't been seen in 20 years that is going to play through in the economy. And I think sometimes it can take a little bit longer than people expect it to, but I do think that that we'll see cuts this year. And it's not just, Terri sort of, putting that out there. I mean, when you look at the yield curve, it is still inverted, meaning that the short end of the yield curve, 90-day treasuries, are paying higher level than 10-year treasuries and even 2-year. And when that's what that's saying to us pretty loudly is that we're going to see a cut, and we'll probably see it. I would be very surprised if we don't see a couple of cuts by the end of this year. We're still expecting that. We think the data supports it, and certainly the yield curve is telling us that as well.
I think it's a really interesting environment because you have almost in equal parts here people who think the Fed should cut to get out in front of a weakening economy. And that's versus those who sort of like the idea of keeping rates steady. And then you have those who think higher rates are absolutely needed to fight inflation. I'm not sure if it says more about, well, it's always hard to predict the future, or if it says more about this complicated environment that we seem to have gotten into. What do you think?
Yeah, I think that's really interesting debate, and I think it's a complicated issue. When you look at inflation, it's above what the Fed has clearly said is their 2% target, and that's their I don't think it's quite their mandate, but they publicly said for a very long time that 2% is their target, and we're above that. We're a 3%, and as you mentioned. Leading up to this show, you're going to be looking for at the earnings, at average hourly earnings in the jobs report tomorrow, because that's going to give us some good insight as to, how far above this 2% level are we? And as much as it's important to the Fed to get inflation down to 2%, I think that they can cut before kind of, they actually see that print. And so I don't think they need to keep raising rates. I don't think there's areas of clear overheating anywhere in the market. I don't think the labor market's overheating. And I think when you have interest rates go up as sharply as they have recently, that's going to slam the brakes. So, we do think that inflation's in control and it's moving in the right direction. There's no areas of overheating. And so it's safe certainly to keep rates where they are and to, just give a little bit back to investors.
So if the economy slows down and the Fed has leeway to begin easing as you expect, I'm wondering why the bond market is not a buy here. You're saying perhaps it's not the best opportunity to go into the bond market here? I mean, I'm wondering why.
Yeah, and I think that's a good question, and it's one that we've been wrestling with. I mean, kind of, at the start of the year, we did a lot of pencil to paper to do we want to lengthen duration, and what meaning specifically, do we want to kind of lock in these rates that we're seeing now, because a year from now, 2 years from now, we're going to look back and say, wasn't that grand back when we could get 5%? Now we can't get it anymore. What we really are doing in the bond market is just looking at what the market is telling us right now, and where we're seeing the best opportunity is still in the very short end, and keeping that 5%, just kind of constantly rolling that over and over again, and not taking any risk in our portfolios in terms of the fixed income side of things. So that's really why we haven't been, I guess, backing up the truck and buying duration and looking for gains there.
On the intellectual level, what do you make of Bill Gross's comments about the sort of total return approach that he championed for so long of buying bonds is now defunct? Basically, he says that yields are a lot lower, and it doesn't give you really all that much room for price appreciation. Your thoughts quickly.
Oh, I think that there can be room for price appreciation, but that's just not really where we want to take risk in the portfolios. And I think that, the bond market is saying that clearly, and that's how we've got things positioned. You're going to make money on the large cap tech side of things, on energy right now, and then keep some fixed income safe for the bad days and the bad weeks.
All right, Terri, thanks so much for joining us. Terri Spath, founder and chief investment officer of Zuma Wealth.
This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.